Okay, in this tutorial, I'll be going through with the stock name DORM. I will just copy that, paste it in Google, and write stock beside. And the stock name is Dorman Products Inc. The information on the left is from Google and on the right is from Wikipedia. If I want to buy the stock right now, I can buy it from 83.82 US dollars, which is one stock will cost me that. And if I want to know when was this founded, I can just have a look here, founded 1918. And let me go to the macro trends website. Here we can see the ratios for the firm. I have left the link in the description so you don't have to worry, and make sure that the name is same, matches the symbol. And price book ratio. Book value is the real worth of the share and stock price is the market price. So if the book value is $1 and the market price is $2, that means that you're paying $2 to buy something that is $1, which is expensive. Looking at price to book ratio. If if the ratio is less than 1, that means that you are buying a discount stock. You're buying a discount stock and it's undervalued and it's cheap and it's good to buy right now because it's very cheap. If it's 1, then it means that you are not buying an expensive stock and you're not buying a cheap stock. It's the real price of the stock that's worth. So, which is also good. At least you're not buying something very expensive. So if it's more than 1, that means that the stock is very expensive. So you're buying it expensive, and um, the higher the number goes, the more expensive it gets. So let's see what's the ratio right now. Right now it's 3.91, which it means that if somebody buys a stock right now, they will be paying 3.91 times more money. So it's 3.91 times, nearly 4 times more expensive. They're buying the stock. But if they bought the stock in 2008 June, they got it at a discount because it's less than 1, it's 0.75, which means that they got the stock cheaper at a discount. If I just go up and I see that book value, so somebody who bought that time in 2008 paid $3.86 for to buy something that is $5.16. So they paid less to buy something that is more. So which is brilliant because they got it cheaper. But right now, if somebody buys a stock right now, they will be paying nearly 4 times more money, which is expensive. So you need to be careful about that. Let's look at other ratios, and I'll be having a look at current ratio. Current ratio means that if assets are more than liabilities. If the ratio is less than 1, that means that it's a risky stock because liabilities are more than assets. If the ratio is 1, that means assets equal liabilities, which is a good thing. But we are looking at a stock that is not risky, that is safe, that is secure. So we are looking at ratio 1.5 or more than that. So right now it's 4.74, which is brilliant because it's a lot more than 1.5. Let's look at the previous trails and see if it has ever been below 1.5. No. So we have data since 2005 up till now, so it's nearly 14 years we have data, and consistently it has been above 1.5, which means it has been consistently safe. And let's go to debt equity ratio. Debt equity ratio means that if the company is mainly operating on debt or equity, so if the ratio is zero point 0.5 or less than that, then it means that it's a very safe company and it's has a good margin of safety. It should be zero point 0.5 or less than that. Let's have a look. Okay, So it's zero, so which is brilliant because it's less than zero point 0.5. So right now it doesn't have any debt, but still we're looking, even if it has debt, it should be less than zero point 0.5. So the previous trends are zero, and let's look backwards. Yes, so since 2005 up till now, it has always been less than zero point 0.5. So which means that it's very safe, it's very good, and consistently it has been very safe. The return on equity should be 8% or more than that. Let's have a look. Return on equity is 17%, which is brilliant. It's a lot more than 8%. Let's look backwards as well. And yes, so it has never been below 8%, which is brilliant for the firm consistently. That's brilliant. Let's look if this company pays any dividends. I'll just click here, and you can see that it doesn't pay any dividends, so there's nothing there. So dividend tells us that a firm has extra money after paying their creditors, their loans, their costs, and everything. They still have money left, which they pay as dividends. This firm doesn't pay it. It doesn't mean that there are firms that are doing very well financially, but they choose not to pay dividends. So it's not that. But if some firm is paying dividend, that reflects that they're doing very good financially. So it's just a it's a test to check. But there are many firms that don't pay dividends, but they are doing very good financially. So there are many factors to consider. Let's look at Yahoo Finance and see what the executives are getting. So we need to know that as well. We need to find out, go to profile, and we can see the sector is consumer cyclical, and it's auto parts industry, and this is the employees. And that's brilliant because we have five executives and all of them have the salaries shown. The more transparent or the more information a firm provides about the salaries and everything, the better trust we can build, because it's more transparent, hopefully. So let's see what the employees have to say about it. I normally check Indeed because I think that's a brilliant website to check. And there are 120 reviews, which are good, and it's 3.7 stars, which is above average. It's nearly 4 stars from 120 reviews, which is brilliant. And you can read through their comments as well if you get time to get to know what employees think about it. Secondly, I always check Glassdoor because that's brilliant as well. So I would say there are 110 salaries, um, sorry, 107 reviews and 3.4 stars, which is above average. 107 people thinks, which is brilliant as well. You can just go through it. Let's see if it has any patents, because any firm who has patents, that means that they have competitive edge. So not interested in inventors because they are people who invented, which is very brilliant, but these people don't have the full rights of the patent. We are looking at applicant or assignee because these are people who have the full rights. So let's see, in 2006 they have a patent, 1986 they have a patent, 1970, no, that's a different assignee, so be careful with that. And so you can just go through it as well and make sure that the name matches the patent. So that's 2006, another patent. 2006, that's fine. 1986, 2008. And be careful that if they have recent patents in 2015, 16, 17, 18, because it's important that maybe some firm has just started. It's important that they're still having patents, they're still innovating, they have it's not that they just started and they have patents and then they left. That's not very good. So patents act as a moat. It gives competitive edge, and it's brilliant. Um, and lastly, I want to show you just a small bit, but it's just a bit easy. I want to see if it's a billion or million company in terms of size. So the market cap is in billion, which it means it's a big firm in terms of size. So